Before we get started, I made a free Discord. You can scan the QR code on the screen now or join with the link in the description. So for this video, I'll be touching on a few things seen in this video. It's an incredible video and I highly recommend you go watch it after this one. The idea of a securities exchange comes from Venice in the 1300s, where lenders would meet up with clients to exchange debt securities. Belgium had the first true stock exchange as far back as the 1500s. Brokers and lenders would make deals with government, business, and individual debt, and these were largely done with bonds or promissory notes. Stocks weren't actually a thing yet, but companies would still issue income to finances like banks. In the 1600s, the first public company was created, the Dutch East India Company. They would go on to issue shares to fund their spice trade ventures across Asia. And it wasn't long after that a bubble emerged when the South Sea Company couldn't deliver on their promises of large dividends after blowing all their capital on hookers and very nice offices. I'm definitely seeing some parallels here with a very popular electric car company, if you see it. The Philadelphia Stock Exchange was the first in the US, and not long after our beloved NYSE or New York Stock Exchange was born. So how do markets actually move? Well, on a fundamental level, a stock price is just what a person is willing to pay for the share of a company or an index. But in that price is what investors think the company is worth now and what the stock should be worth in the future if the company delivers on expectations. This is actually where earnings season comes in. This is a very important time in any trader's calendar when companies report their performance to the SEC. This happens 4 times a year and makes the markets very volatile, so it's recommended not to have any short-term trades open during these times unless you understand the risks that you're taking on. And now to get to the source. A market price is made when a buyer and seller agree on a price. This is mainly done through 2 avenues, limit orders and market orders. A limit order is a stagnant buy or sell offer at a predetermined price. These orders can be filled by other limit orders making offers at the same price, or market orders. These are orders that will automatically fill the nearest limit order to be matched as soon as possible. All these offers make up the order book. It usually looks something like this. You can view it by pressing the trade button down the bottom here, and then the DOM up the top right. Then it'll show a price ladder. There are a bunch of different ways of displaying this information, but it's all the same. This shows the spread in the middle in white, sell orders on the top and buy orders on the bottom, and the amount of active orders at each price on the side. You'll need to sign into an actual broker to be able to view real orders. Orders tend to cluster like this when investors are confident about the market and the surrounding economy, and will spread further apart in times of uncertainty. A retail heavy trading strategy that uses order books is order flow trading. So if you're interested in that, not the right video for you, but go look into that. The charts will look a little bit like this, but it's all the same information. Now for a little economics class. Economics is just the study of how we as a society distribute goods and services, and the most basic fundamental of this is the law of supply and demand. There actually is a trading strategy based on this idea, but it's pretty far removed from the actual fundamental economics side, so we won't be talking about that. To put it simply, it's the idea that markets are priced based on supply and demand of the asset. If there's more demand and less supply, the price will go up because people are willing to pay more for it. And as you can probably guess, the price will go down if there's an abundance of the asset, but no demand to meet the supply. This doesn't only apply to the stock market, but every market. I mean, crypto, bonds, prediction markets, exchange rates, the list goes on. Even when you're shopping, I mean, buying more eggs than you normally wouldn't actually affect the price of eggs. But if hundreds of thousands of people bought an extra carton, it would theoretically push the price up as the supply runs low. The problem with a market like this, and the idea of a free market as a whole, is that the more control and power an individual or company has over the price, the more likely they're going to try and exploit it. We actually see this fairly frequently in everyday life. In Australia, we have fuel cycles where the price is constantly fluctuating. Same with groceries. Like, there's no actual fuel shortage, but over the course of 2 weeks or so, the price of fuel will slowly increase for no reason at all. There are dozens of ways that people have tried this in the stock market and have even succeeded. For example, before it was banned in 2010 under the Dodd-Frank Act, traders used to create false demand in the market by placing thousands of orders slightly above the market price, and then cancelling them before they could get filled using high-speed trading systems. This false demand would inflate the price, allowing them to offload shares they previously held to unsuspecting investors for a higher price. A similar scheme actually put the Jane Street quant firm on the map. You can see it was right about here where they started manipulating the Indian options markets by buying calls then pumping the underlying stock, allowing them to make insane gains on their options. Understanding how these markets work on a fundamental level is an essential step in creating your own strategy. So make sure you know all these concepts like the back of your hand, and I'll see you in the next video. Goodbye, bye, bye, bye.